Right now, the U.S. is imposing sanctions. It's a form of economic warfare, and it has a big implication for the dollar. Okay, now others are trying to get out of the dollar system. There's a dollar system that now is being changed. India is dealing directly with Russia, and holders of dollar-denominated assets don't want to hold those dollar assets if they feel that they're going to be grabbed and so on. So what's happening now has happened many times before. And I learned this in my past because in 1971, I was clerking on the floor of the New York Stock Exchange, and President Nixon gets on and he says, "We're not going to give you the gold that the dollar is backed by," and we had a devaluation. It took me by surprise. I walked on the floor of the stock exchange. I thought it was going to go down a lot. It went up a lot. And that's because I never experienced the currency devaluation. I found the same exact thing when I studied history. Same exact announcement took place on March 5th, 1933 by Roosevelt and had the same effect. So I understood then how history before me was important. Studying the Great Depression allowed me and Bridgewater to anticipate the 2008 financial crisis. If I didn't study that, what's happening now is very relevant. The past is a guide to what's happening now. As we are approaching a challenging of the world order, in other words, a great power challenging another, there is an increased likelihood of some kind of war. There are 5 kinds of wars. There's a trade war, a technology war, a geopolitical influence war, a capital war, which we're in the midst of, and then there's a military war. And those things drive countries to be self-sufficient and independent. And as a result, globalization diminishes and nationalism increases. It's not the stock market. So it's, in the book, it takes you through the stock markets during war periods. And so the only thing that matters for stocks is the cash flows. And as you get into the conflict, that's a different story. If you begin to see, as it progresses, those that are affected by the individual events have an effect, for example, tech stocks. But anyway, in answer to the question, how does it affect the markets? It affects the value of money, most fundamentally. Like what we're seeing now is that the value of money, when you run very large deficits, you have to spend a lot. You have to spend a lot on social programs. You have to spend a lot on defense. You have to spend a lot on environmental programs and so on. And so when you spend a lot more money than you earn, then you have to print money to make up that difference, to make the purchases. And then that devalues money. And so it's like the examples I gave you of the 2 currency devaluations that you had before. 1971 led to the inflationary period of the 1970s. And so you have the stock market. Yes, the stock market goes up and other things, but cash is trash. And people then begin to learn that the bonds that they're holding have negative returns. And it starts to change the value of money, the value of dollars and so on. So money goes into other assets. It produces more of an inflation, and you start to enter a certain type of environment. And the environment that we're in is beginning to be very much like that of the 1970s. There's 2 ways of dealing with debt. You pay it back in hard money, or you pay it back in soft money. You pay it back in hard money and you have a problem. You have a depression. So throughout history, whenever that was done, pay it back in hard money. Eventually, that was abandoned and you print money. That was what 71 was. That was what March 1933 was. And so I think that what you have to think about is the value of money. How much money does one have in debt instruments? And do you want to own that as an asset? I think they're bad assets. And then how do you diversify? And the system also has to deal with what is money? Is the dollar going to remain the same sort of reserve currency? And then you see the development of alternative monies. We're seeing a variety. I think different types of money will compete with each other in the environment we're in. Maybe it's crypto, maybe it's gold, maybe it's other things. Maybe the digital renminbi competes with the US dollar. We're going to come into an environment. Think about how much money is being stored in debt instruments, those debt assets. Think about how poor those returns are. So that kind of a shift, I think, is very important. All currencies have a lot of debt. So when you look at one relative to the other, there will be a lot of printing. I mean, currency equals debt. And when you hold a currency, you're holding a debt instrument. And so all of those will decline in value relative to other things. Now, will the dollar decline more than other currencies? It's almost certain that we're going to come into this environment. We're in this environment in which there's a shifting of those currencies. So you're going to see more of China's renminbi being used. You're seeing India have a direct link with Russia on the currency. So we're in an important change in the currency. But how that is a store of wealth is a different question. So a currency is a medium of exchange and a storehold of wealth. And its storehold of wealth is now a problem, particularly for the dollar, but it's also a problem for other countries. So that's why you have inflation. As money goes into other things and the cost of borrowing is so low relative to the inflation rate, then it encourages the borrowing of money and the sale of money. In other words, not holding financial assets like that. So that's, yes, I think you're changing the nature of what money is and what the dollar is as a storehold of wealth. We're beginning a paradigm shift. A paradigm shift is a shift from a mindset and positioning of that mindset to another mindset and another positioning of that. So, for example, the mindset that we were in was that you have low inflation, and when you're owning bonds and you're owning cash, or you are operating one way, and you don't worry about that, and companies don't worry about it in their inventories, or having larger inventories, or homeowners don't worry about inflation as much in the purchases of the houses and so on. Once that shift begins, it causes a reinforcing dynamic. It's like everybody is long bonds. We've been in a 40-year bull market in bonds. And so it's been fine to have. And when that shift starts to take place, you see behavioral shifts that reinforce that cycle in the paradigm. So for example, when there is the selling of bonds, that makes it more inflationary in and of itself, because the amount of debt that has to be sold is not just the deficit, but also the amount of debt that's being sold is those bonds. So now interest rates have to rise a lot, or the Federal Reserve has got to come in there and buy more. And then you get wages. People make wage settlements and such things. So a paradigm shift is beginning to take place, and that will be also self-reinforcing. And it's taking place in this context of the conflict, which then creates the breakdown of efficient systems. Each country wants to be self-sufficient. It needs to protect itself. And in being self-sufficient in that way, then you have less efficiencies in the system. And all of that becomes self-reinforcing. So it's all happened before. It's all happened many, many times before. Yeah, I'm concerned about that. When you raise the return on bonds and you raise the return on cash and you tighten money, then that makes other assets less attractive, such as risky assets, particularly long duration assets like tech stocks and the like. So you produce that squeeze, yes, but that's still only at 2% or a little bit over 2% with an inflation rate which is considerably higher than that. We've had a 7% inflation rate, and we'll probably settle, it'll be a 5%-ish or something. And so you're still losing that money to inflation. People are. So what you have is enough tightening by the Federal Reserve to deal with inflation adequately is too much tightening for the markets and the economy. So the Fed is going to be in a very difficult place a year from now as inflation still remains high and it starts to pinch on both the markets and the economy. Here's the problem. If you're borrowing more money than you're lending and you have a lot of debt, you either are going to pay back in hard money or in soft money. And so it creates a very difficult trade-off. So what can you do? Do you spend less money? So that the trade-off becomes more and more difficult. And that's what brings about a stagflation environment, because they tried to navigate between those two undesirables. In other words, they want to contain inflation, but too high of an interest rate that's good enough for inflation causes too much economic environment. So what can they do? No, they're in a position already because of that dynamic, spending more than they're earning, creation of a lot more debt, and a lot of other debt, which one man's debts are another man's assets, and that as the holder of that assets is losing money. Imagine holding a bond now. Look at how much money is in bond funds and cash. Okay, not only in cash, you don't get any return to compensate for the interest rate, and in your bond fund, you get negative returns. And how's that feel? So are you going to continue to hold those bonds in that bond fund? It's a dynamic that they have to deal with that is really beyond their capacity to deal with it. They can't change those fundamentals. I think that most likely what we're going to have is a period of stagflation. And then you have to understand how to build a portfolio that's balanced for that kind of an environment. So every investment is an exchange of a lump sum payment for a future cash flow. And so the cost of money is a consideration relative to the return on money. And so when we look at that return, when we say I can hold cash or I can hold a bond, that changes the inclination to hold cash. But also, one has to look at the expected return on equities. In other words, one calculates the present value of future cash flows. You estimate what are those earnings going to be in the future and what are they worth today. Stocks are now having expected returns, which are not very much more than bonds, which would be not very much more than cash. So as that happens, so that why should I own equities farther out, and have the volatility of equities? So that shift in the curve, in other words, the relationship between cash, bonds, and then the relationship between bonds and equities, and the relationship for corporations between the rates at which they borrow at and the rates at which they can earn money at, have a pervasive effect on the economy and the markets. So no, it's important to take a look at that relationship, that yield curve structure that way, but you should go beyond that and include the returns of other assets. What can you do in the way of generating returns relative to the costs of money, the relative attractiveness of those instruments? You have to have an economy in which the people believe that you have a fair system and you have to have productivity. So I would say the most important thing is the redistribution of opportunity to make people productive and to eliminate the internal conflict or to reduce the internal conflict, which can be so disruptive. When you see large wealth gaps and at the same time you see economic problems, you have a lot of internal conflict, and that internal conflict is bad economically and it's bad socially. But it's not just the wealth gap, it is the productivity level that results. And it's certainly going to be a political issue. So when we talk about markets and the economy and all of these things, we have to realize, for example, that internal conflict will have a big effect. The world order was made in 1945 at the end of a war. And a civil war can begin a new order inside of a country. The Chinese Civil War began their new order 1949. And so that's like a new beginning. They always come out of wars. And a war is a fight for how the system works. So we'll begin there. After the fight of how the system works, it's a great leveler. It gets rid of a lot of the debts and it starts over. And then there's a new power. In the United States, the New World Order, it was an American world order because the United States won World War II. It had 80% of the world's gold. Gold was money. It had the dominant military power. It had nuclear weapons. And because of that, we began the American world order. They carve up the world. Here are the borders. This group gets this piece and so on and so forth. And then they begin. And by the way, this has happened repeatedly throughout history. And so they start off with those new rules of the game. And you enter a period of peace and prosperity. And it's peace because nobody wants to fight the dominant power. The dominant power won. And there's a change in psychology really that you're dealing with, because quite often these things take place. They take a generation or more to take place, a lifetime. And the people who enter the war do so boldly. But everybody who enters the war and then goes through the war, wish they never went through the war because it's so terrible. But they come out and the war is over. They want peace, they want productivity, and so on. And it's a great leveler, less wealth gaps and so on. And they work well together, and they build a period of peace and prosperity that is a long period of peace and prosperity. But during that peace and prosperity, more and more prosperity takes place, and they increasingly bet on that prosperity, and people get more in debt. And so you see the debt levels rise, and you see naturally, as prosperity comes, it comes in unequal ways, and some get richer than others. And so wealth gaps rise. And then those wealth gaps increasingly create opportunity gaps because the rich people have more resources to educate their children and of them the benefits. And so that happens over a period of time while the economy gets more indebted. And of course, as time progresses, other countries also rise. Those maybe that even lost the war, like Germany and Japan, they rebuild and they become competitors. And so what was a unique power of having won the war becomes less unique as there was more competition. And then you get a new generation of people who have a different mentality. They get used to those benefits and so on. And they are, let's say, less cautious in their financial behavior and so on. And so the classic ingredient also is that that country that wins the war also has the world's reserve currency. Because, okay, you need a currency to transact internationally. It's like a language, you need a language to transact internationally. And the winner of the war gets the world's reserve currency because everybody thinks that's the most stable, and they also want to save in it. So I think there are three big forces to keep your eye on. And when you see them in their cycle, then it's clear. First, are you earning more than you are spending? I want them to look at it as the country, but the country's nothing more than the aggregate of the people. And so when you look at those three forces, I want to make sure that they're clear and you could align them up and you could see where you are. Is the country earning more than it's spending and building savings? Or is it spending more than it is earning and creating debt? Because one man's debts are another man's assets. And when somebody is holding those assets and they're producing a lot more of that money in debt, money goes down in value as they produce it to produce that buying power. And then that gets people bad returns. It produces a higher amount of inflation. And then people get out of cash and bonds. And that produces rising interest rates while there's rising inflation. And that produces stagflation. So I want them to get the mechanics of that, because that's happening now. You could see it. This is not controversial. We are producing a lot of debt. We're spending a lot more than we're earning. And as a result, they're printing a lot of money. And the printing of a lot of money creates a lot of inflation. And with that inflation, cash is trash. You don't want to hold cash, and you get out of that. And that causes rates to rise. And that's one of those three factors. So you can see it happening. The second force is the internal conflict force, how you are with each other. Are you operating cohesively, common mission, and moving in the right direction? The system working? Or are you at each other's throats? Is the system threatened? Because history's shown when the causes that people are behind are more important to them than the system is in jeopardy. And that is a risky situation. It's a risky situation because it produces disorder and it can produce a form of civil war. And at those times, when you have that, you see greater and greater polarity. In politics, it shows up at greater and greater populism of the left and populism of the right. And populists want to fight for their side. They're not moderates. Moderates want to work together to try to find a compromise that's best for the whole. Populists appeal to their crowd by saying, I am fighting for you, and they will fight each other. And that fight can be at the threat of the system. So in history, for example, we saw 4 democracies in the 1930s choose to become dictatorships as one side fights to the other because they become so disorderly. And we have a system right now that you could see that it is possible in elections that neither side might accept losing. And so the system becomes in jeopardy. And you see that the moderates leave the system. It can't be moderate. You have to pick a side and fight. And so you see this in the French Revolution. There were moderates in the early part of it, that recognizing that there were problems and wanting to work together. The moderates got guillotined. Polarity began. The same was true in the Russian Revolution. The same was true in the Chinese Revolution, the Cuban Revolution, and so on. Polarity gets greater and greater as there's a greater intensity to fight. And that is the internal piece. So that's the second force. And the third force is the rise of a great power, the geopolitical force that's going on, that we're seeing today with China and Russia and so on, and how that's changing. Because when the power of a country diminishes, when we get weaker financially, or how we are with each other, and so on, there are greater vulnerabilities. And there's always the competitive power that learns how to become stronger. Competition always happens. There's the establishment, and then there's the new competition. And as they get stronger in all ways, militarily and commercially, and so on. And that's the dynamic that we're seeing. The events that happened in the Ukraine, and that is bringing all this development internationally up at a little bit quicker pace. It's the same dynamic. There are two sides, and there'll be neutral countries, just like in the war. There was the Allies and the Axis powers, and then there are neutral countries. And so that part is developing. The U.S. conflict part is probably progressing a little bit quicker. On the world order, the developments in the Ukraine, maybe I should put those in perspective. There is a very close relationship, a common objective of the Russians and the Chinese. So there is a competition in the world, and there's a dominant world power which is perceived as being overly controlling. And there are 5 types of wars. There's a trade war, there's a technology war, there's a geopolitical influence war, there is a capital war, and then there's a military shooting war. And we are in the first 4 of those wars in this competition with China. We are in a shooting war of sorts with Russia and the Ukraine. We're providing arms, and so they're shooting. And so there's a military war going on, and we're in it in our way. So we're at those particular spots. And the capital war is sanctions. We hear the notion of sanctions. And what that means is they're economic. And the way they work is to shut off, to produce economic pain by either not letting them get at their money or not letting them get to goods that they can import. And these have happened through time. In Japan, that was what set us up for the bombing of Pearl Harbor, because the United States cut off Japan's oil supply, was in the process of doing that, and also confiscated its bonds, much the same way as happening now. And that put them into a corner that led them to bomb Pearl Harbor, and then we went to a military war. So that's where we are now. And that also is risky because it threatens the value of the dollar. Because right now, debt is dollars. Any currency, the way you hold it is you hold it in the form of debt. You don't hold it just in paper. And because there's a rising inflation, and because there's a lot of printing of money, and because there's also a greater fear on a number of countries that they too could be sanctioned, there is a selling of dollar-denominated debt. So you're seeing that the bond market is going down. And so there is that dynamic that's going on. The capital wars are the ones that accelerate immediately before the military wars. Usually the coffers are empty, they're printing a lot of money, and then they're trying to use economics as a weapon. So we're in that part of the cycle. Now, in terms of how this will transpire, I think there are 3 big questions that we're going to get answers to pretty quickly. The first is, does Putin and Russia win or lose? I'll describe win as what he wanted at the outset, which is win for Russia would be to have the Ukraine be some non-threatening position, such as a neutrality, a guaranteed neutrality, and for Russia to have control over eastern provinces, and for Russia not to be economically devastated, instead to be maybe have it something like a 10 or 12% decline in GDP, and for Putin to be in power. If those four things happen, then the cost of his actions will have been worth what was obtained from that. And that would be viewed as a win. It would be then also a loss from the Western countries. The world is looking at the power of American sanctions because American sanctions are the greatest power the United States has because it controls the world's reserve currency. That's a biggest asset. But in weaponizing the dollar, it is leading those to get around and not want to hold dollars because they get worried that they're going to be confiscated. So we will see if that dollar sanctions power, we'll see how powerful it is. If it isn't very powerful, that's going to be a problem. While Russia is throwing in military, we are throwing in sanctions. And these sanctions don't cause lives. It's not a military war. So we're fighting it with sanctions and they're fighting it with military. If you didn't have that, how would you fight this war? It would be a much more difficult situation. And the third thing that we're seeing is how the world is lining up, which, there are in wars, typically Axis and allied powers. And you could see by the actions that are taken as to which are lining up. Who voted in favor of what at the United Nations? Who is allowing what rules? Who is trading with the other party? Russia actually put out a list who are friendly and adversarial countries. And that's making clear how the sides are lining up. So you're seeing those sides line up and all sides are in preparation for war. And so psychology should change and is in the process of changing to realize that you have to think in terms of buying power, not the number of dollars you have. And you have to think how much is your buying power. And so the worst thing is to be in cash. Like I say, cash is trash, and to be out of the bonds. The next thing is to have a diversified portfolio of assets with a bias toward inflation-protected assets. And I would want to diversify between locations, countries, in terms of the investment based on the criteria I just mentioned.